You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. Welcome back to the Advisor's Option, the program for you out there, the busy asset manager, RIA, financial advisor out there who maybe you're intrigued by options. Maybe you're using them in your own practice right now. You want to learn a little bit more. Maybe you're just trying to dip your toes into these options waters. Don't worry, we got you covered. Got some education, got some analysis, got a whole bunch of breaking developments from the world of options that you may have missed, and maybe even will answer some of your questions here on the old program. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you like this program, make sure, if you haven't done so already, you subscribe to the full network. You can find it in any of your podcast providers of choice, or grab our mobile app, or go to our website, or any of our partner sites. The Swan folks have it up on their site. You can find it there as well while you're reading the Swan blog. Maybe you tune into an episode or two of the Advisor's Option and check it out for yourself. And of course, however you listen, live after the fact via our mobile app, via the website, however you get the show, make sure you send in those questions. We do, yes indeed we do, like to hear from you guys. And joining me on the program today, we got a great panel to help me dive into the world of advisors and options, starting off with our cohort holding down the hot seat from up there in the Northeast. kind of hot this time of year, so I'm sure they're enjoying that. Mr. Matt Amberson, the principal and founder over there at ORATS, aka Options Research and Technology Services. Matt, welcome back to the Advisors Options, sir.
Thanks, Mark. I listen on Pocket Casts, and I listen to you at 2x speed, so you sound like you're talking really slowly right now.
Do I sound like Alvin and the Chipmunks there over there? Well, I understand. I already talk fast as a normal human being, so 2x, it's got to be borderline unintelligible. But hey, I love you. That means you're consuming our content at twice the volume. So twice the amount of content, so we'll take it. I'm a Pocket Cast user myself, so that's my platform of choice because it jumps across all platforms: iOS, Android, web, you name it. PC, Mac, whatever the heck you got going. Pocket Cast works across all of them, so I like that because we're a myriad devices here, and we like to be able to talk to all of them. Speaking of talking to all of them, see who else we're going to talk to today. Let's beam in the dynamic duo from Swan Global Investments, starting out with our old friend Chris Hausman. He's a director of risk management and chief technical strategist over there at Swan, also joined by Dan Nigoy. He is the senior trader and strategy development over there at Swan. Gentlemen, welcome back to the Advisors Option Program.
Hey, Mark. It's good to be back. I'm now beginning to use the show as a marker for 1 month of life because I know I've lived another month every time I have to do this.
You've survived another month, yep. Which, down there in Puerto Rico, it could be a dicey thing. So you're living month to month, living on the edge over there in the frontier. I like it. And Dan, are you doing the same thing? Is this a marker of the inexorable encroachment of death to you as well?
Yeah, it's something like that. So we have a calendar where we mark off the boxes, and the invite for this episode came around much quicker than I was expecting.
Well, there you go. I'm glad to see we're keeping. Always can count on Chris for a nice upbeat start to the show. All right. With that in mind, let's get into the Options 101. Because you asked for it, it's time to break down a little bit of options education.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody. Welcome to Options 101. Matt, I hope you did your homework from last episode because our listeners are a good bunch, and they always are diligent in giving us homework. And so we always tell you guys, ask and you shall receive, and you have done so yet again. This particular Options 101 segment was actually inspired by some listener feedback to another segment we did earlier where we did, remember you listeners, we did recently a very deep dive, interesting stuff into calendar spreads. And I said at the time, I know this is going to spark a lot of interest, a lot of questions, a lot of follow-ups. So we got a bunch last episode, we answered them. This one, including this one, which was kind of an interesting idea, and they sent it in. This came from TLC, and they asked, can you guys do a show on short calendars, why someone should use them, pros and cons versus long calendars, and maybe a cool back test or two, which is the Matt's homework part of the equation. We'll check in for a minute in a little bit and see if he did his homework or if the dog ate it here. But let's break down exactly what we're talking about here first. If you're a little bit confused, we talked a couple episodes ago. I encourage you to go check out that episode if you haven't. That's a full dive into what are traditionally calendar spreads, long type calendars, which is, of course, you're buying a longer term. Let's keep it for our purposes very simple. Let's keep it at the money strike. So usually you're buying a longer term, let's say 1 month out or 2 months out in this case, at the money call. Let's keep it for calls. Calls are much simpler for people to process. And you're selling a narrow term contract, in this case, a 1 month. Again, at the money call. So you're buying a longer term option, selling a narrow term option, same strike, different expiration months. That's how calendars are usually viewed. That strategy has a lot of value for people who maybe think the market's going to sit around for a while, then maybe pop or move in a direction or vol's going to increase after that point. That's the usual use case. That's how we broke it down. But TLC wants the other side of that coin, the dark side, aka the reverse calendar, aka a strategy that, quite frankly, we don't talk about a lot, not just on this program, but on the network. It's not one we get requests for a lot. It's not a very common strategy people use out there. So maybe we'll get into that a little bit. So we're flipping the script now. So instead of buying the longer term contract, let's say in this case 2 months out, you're going to sell that at the money call contract and then turn around and buy the narrow term contract. So you can imagine all the pros and cons of kind of the other ones are kind of flipped. before you wanted the market to sit and kind of not do much for a while until that front month contract expires. And then you want it to take off, or the vol to take off, or do something after that because you have that long leg sitting there. This is kind of the opposite. You're long a lot of front month or a nearer term contract. So you got a lot of gamma. So you want this thing to move and move a lot in the near term portion. And then once that happens, maybe kind of sit or trend in the direction you need, kind of coming into that short strike. So it's a weird strategy that so you can see by definition how that isn't a use case a lot of people envision on this one. Not a one a lot of people, again, ask for. Benefits of it, of course, a lot of long gamma. So if you want some near-term kind of popping, you get that. And you're also, by doing this the opposite way, before you had a debit spread, you were paying to buy the longer-term contract. It's going to be more expensive, and you're collecting a little bit to sell the nearer term, but not as much to offset the cost of the longer term contract. So you're paying, that's AKA a debit spread. By flipping this around, you should be able to turn it into a credit spread, I should say. So that could be attractive to a lot of people, not having an outlay for those sorts of things. The drawbacks, of course, are, of course, the way you have it usually, a long calendar is done that way because it maximizes your theta. Pushing the longer leg a little bit farther out delays decay on that leg. Meanwhile, pushing the short leg closer to expiration accelerates the decay on that leg. That's exactly what you want. This spread flips that. So now you have the longer term one, the leg that is prone and subject to decay, closer to expiration, which means it's going to decay faster. And the shorter leg, which what you want to decay, is going to decay slower. So that's another reason why this spread isn't super popular because you're kind of you're playing with theta from the wrong directions. Another thing we'll talk about this maybe in a minute too is maybe margin-wise, it may not be the most favorable type trade. But before I keep going, Matt, I know you're champing at the bit to get in here and discuss your homework. So first off, can we check in with you? Did you do your homework from last episode, sir?
I did, Mark. I'm a very good student, and my dog, although she's around, she did not eat the homework.
That's nice. Can kids even get away with that anymore in the digital age? The dog can't eat your digital homework anymore, can they? So they've kind of lost that seminal excuse.
They don't have as much to blame things on these days, Mark.
Well, Matt, I knew we could rely on you guys and your team over there at ORAT's, always doing the good back test. I think one of the reasons you wanted to do this, Matt, was because this is probably not, I don't think one you've been asked before either. It's kind of again, not the most popular of strategies for a lot of reasons. So I'm curious, what did you test? What did you test it on? And what were your findings, sir?
Yes, actually, I did get asked to do this test recently. And
really?
So I'll
what are the
I'll
odds?
Bring that
two
into
requests in the span of like a month. That's bizarre.
Yeah, it is bizarre. But, there's some reasons for doing it. First of all, I tested a short put calendar, short call calendar, and then one that's longer dated and more out of the money. And so, as you might expect, you're over the long run, and we run these from 2007 to the present. Just a typical short call calendar was the worst at the money. You have all that theta. So, theta's typically overpriced. You're not going to do that well. That short calendar was the worst performing one that we looked at. And if you look at the worst years first, I don't know if you want to guess, but
I'm guessing the meltdown years were not too favorable for this strategy.
Well, the worst years are when the Vega, because you're long the front, short the back Vega. So 2009 after 2008, you lost a lot on Vega. That wasn't a very good. That wasn't a very good year. 2015 wasn't very good for this call calendar. Basically, 3 month, 1 month is what I tested. The put calendar didn't fare that much better. However, when I did the put calendar longer term and more out of the money, so I did 200-day to 90-day, so long the 90-day, short the 200-day. It was basically break even, and 20 delta, so way out of the money. And it actually performed. I mean, if you the last few years, it's had some returns. The gentleman that that sent me the request to do the short calendar. Very smart guy, doctorate, and well known. I should have asked to use his name, but I'm not. I'm going to keep that confidential. But he actually, and I don't think he'll mind me saying just some general things. He wanted me to test it. One of the things that we could do in our back tester is test things delta neutral, and then when we tested it delta neutral, we did get a decent return. When I say decent, still 0.5% of notional. So, what that ended up doing is, not having the delta, and able to scalp some of that delta of that long. When you're long the front, short the back, you have some gamma. So the delta neutral aspect actually helped the short calendar, Mark.
That's interesting, because I was going to say this is probably a strategy that more favors institutions for a variety of reasons. You kind of just laid some down. The margin treatment could be problematic for a maybe a lower level RIA or even an active retail person. A client comes to an advisor who wants to do this. They're a lot of platforms that handle RIA option business. Let's just say they're not the most savvy in the options world to begin with. They may push back on things as basic as cash secured puts and things. You come to them with a reverse calendar, they're going to look at you a little bit askance. They may tie up a lot more margin than perhaps you're willing to do for this trade as a result. So just bear that in mind. And also, I think as you kind of alluded to it there, Matt, you kind of have to play with this a little bit to really kind of make it work for you and make sense. You talked about a couple interesting ways. I think a lot of ways people would probably end up using these types. I don't want to get into diagonals too much because they're kind of scary to people. But I think the most prominent use case for this that I've seen and that I would consider probably would be some sort of ratio diagonal instead, where you're loading up on one leg, maybe you're loading up on more nearer term calls, short some longer term ones, just because maybe you want to be net long units looking for a big move in an underlying, and you got a ratio set up that way and a diagonal. Doing it as a straight up calendar, again, it's kind of interesting, a little bit head scratching. I am intrigued again that your client was intrigued by this. Which I guess tis the season for reverse calendars, Matt. I don't know. These things always come in waves. We don't get asked anything for a decade on the network, then everyone wants to know about it all at once. It's fascinating.
His thesis, Mark, was that with the vol trade coming back and people getting short vol again, a lot of them are selling those the puts, and so he said, let's test these buying the puts because they're getting so killed. And just I was interviewed today for hey, the market's hitting new highs. What's going on? What's also happening now is the besides the vol coming in since the 15th, when it was the at the money SPY was about 10, it's about 8 now. The skew is also flattening out. So the worry is leaving the market right now. That vol trade, is coming back as you've commented on before, Mark.
Yes, it is an interesting day out there in the marketplace. Maybe we'll get to that a little bit later out there as well. But before we do that, let's turn to our cohorts over there in the land of Swan. Chris, I know you spend your days over there dealing with not quite straight up calendars, but a lot of diagonals as you're legging into some of the strangle legs and other portions of the DRS. So maybe first, before we get into specific elements, I'm curious maybe your thoughts in general on this strategy. Like I mentioned and Matt mentioned, it's not one we hear about a lot. We don't get requested a lot, and all of a sudden it's popular. Go figures. And maybe, do you have any thoughts to start with on just the reverse calendar in general? Then B, what are some of your thoughts about how this could be implemented in the space these days?
Yeah, I agree. I think the short calendar doesn't get a lot of love. Again, I always look at calendars as if they're butterflies. So I kind of equate to how many people are really shorting butterflies out there. I mean, you expect the big move, but it's not one of the more common strategies out there, like, being long butterflies or long condors, which fit more into that traditional income producing bucket. I do want to say that if you're doing at the money calendars, whether you're long or short, same strike, it doesn't really matter if you do the calls or the puts because they're going to be synthetics of each other. So I guess my question to Matt really is, when he's talking about call calendars or put calendars, I'm assuming you're doing like out of the money call calendars, out of the money put calendars, same strike. But the reality is, if you did it on the other type of option, call versus put versus call, you should still get the same results. And I do want to bring up a point because, Matt, it sounds like Matt's pointed out certain years where the calendars didn't do well. But I remember the show that we did when we were talking about long calendars, and Matt did a quick back test, and he also said that the long calendar had, over a long period of time, also had difficulties. So I'm just going to toss it out again that, whether you're doing long calendars or short calendars, there is a Vega disconnect here, and you're trading two types of Vegas, which I mentioned the last time is that modified Vega type thing. So it's another nuance that you have to be careful about when you're trading calendars. Now, as far as from the practical side and how we use them, we use calendars all the time for rolling out positions. So they're very useful when we're implementing on a diagonal sense. But again, just be careful about calendars, where volatilities are, where term structure is, all that kind of stuff. And I think the person that asked for the back test and wanting it delta neutral, I think that's probably the better route to go, because what you're really doing is isolating the volatility in that term structure as opposed to taking on deltas from calendars. Because I think what I've come across a lot is with all this volatility trading, and we keep talking about it, is there's a lot of, if you're not hedging delta neutral, there's a lot of delta involved in there. And there's a lot of delta that I think, your performance is coming from these delta movements and not necessarily from the volatility. Although volatility is sexy and we love to talk about it, we can't forget that, one of the primary drivers behind these strategies is actually delta.
And as I mentioned before, when we did our calendar spread segment initially, listeners, the segment's called Options 101, but when you get into calendars, it kind of is more of a 201 or maybe even a 301. So if you're confused by some of the terms that we're tossing around here, delta, neutral, gamma, theta, vega, all that fun stuff, it behooves you to go back into our archives here and check out some of the early episodes of this show where we explain a lot of that stuff in a lot more detail. Again, calendars, not for the faint of heart always, reverse or regular, but just something to bear in mind if you're a little bit confused. Don't worry, you're not alone. Matt, any thoughts? Chris, Chris has got a long memory here. He remembers even the long calendar back tests. Any final thoughts or nuggets for our listeners when it comes to this very, very unusual but seemingly suddenly popular strategy, sir?
Yeah, Chris keeps me honest, and he also, makes me remember that I'm one month closer to death. So, yeah,
he's very cheerful in that sense.
To answer Chris's point, yeah, I mean, I'm doing slightly out of the money calls, slightly out of the money puts. So I'm just kind of looking at where there's, and going off of that thesis that, there seems like when the short vol trade comes in, they kind of kill the puts just out of the money. So that's what I was referring to.
All right, keep those questions coming. We love hearing from you guys. We'll probably get to some more later in the show. And sometimes, who knows, if it's a good one, we'll put a whole segment around it. If you have questions, we just kind of scratched the surface of this. We could devote, as you saw, many hours to this exact subject. If you have more questions about the nuances of calendar spreads in any directions, maybe if you guys can handle it, maybe we'll get into some diagonals coming up soon, too. That's always an interesting area as well. And you start doing ratios and all sorts of fun stuff. But for now, we'll keep the conversation there. Let you digest that while we keep on moving, breaking down some of the interesting developments going on in the world of options and the markets right now. It is time for The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we break down interesting stories that may pertain to you. This first one, actually, I lied. This first one, not particularly an option story, but an interesting one. A lot of people are asking us about this, so we thought we'd bring it up here because I know we have a lot of managers listening to the show in RIAs who are just generally long a lot of equity and look at things like these broad technical indicators and these technical levels. And, Alice, we don't get a chance to talk Dow here on the show very often, so it might be kind of fun to bring it up. Dow gets a lot of love in the media, not a lot of trading around it. Which is interesting. A lot of people are hitting us up with this article, I think it was on Market Watch a few days ago, about this longest stint in correction territory for the Dow in 60 years. They talked about over 131 sessions. There's a few more now since this article came out. That's the longest session, of course, if you're wondering what they mean by correction territory. It's a failure to move 10% above the closing low hit earlier in the year. The Dow has now spent the longest period in that correction territory, 131 trading sessions, since back in 1961, which the previous record was 223. Now, interestingly enough, an interesting corollary to this, another reason why it's on the show today, is because the level it had to hit to get out of that correction territory was 25,886. And guess what? As of today, the high we hit today didn't close there. So I don't know if, it's got to be closing low. So I guess technically we're still in it. But today we did hit the break deck by two handles. 25,888.82 was the high of the day on the Dow. So there we go. We did break through it, blew through it to the upside very briefly. So technically we weren't in correction ever so briefly, but then we closed 25,822 looks like. So off that level. Again, I'm not a huge technician. I know a lot of our audience is though, and they like in general, all things Dow. We don't get to talk Dow on the show anymore either, which is kind of fun. So I'm curious, maybe Dan or Chris, you guys over there at Swan. I know Chris, you're the chief technical strategist, and maybe this is in your purview. Maybe Dan as well. I'm curious, are you a Dow watcher? I know you trade a lot of S&P, but does the Dow factor in ever? And B, as a technician, do you think these levels are significant of anything, or is it more kind of just noise out there in the ether?
I actually pulled up the Dow chart because of this article that you had posted here. So I don't watch the Dow all that much, but it is interesting. I mean, they're all levels in that 886. Running up to it and not closing above it is, I don't know. For people who attach value to it, maybe there is something there. Whether or not it makes it up and takes off to new highs like the other indexes remains to be seen.
Yeah, the Dow traditionally kind of the redheaded stepchild, at least from a trading activity when it comes to these indices. Matt, do you get a lot of inquiries to back test strategies on the Dow? And then B, what are your thoughts? I know you're a bit of a technical guy. What are your thoughts on these technical levels and the fact that I guess technically we broke it today or close to it?
I like the Dow, Mark, because it goes back so far, and we're still working on that extremely long back test. So the Dow is near and dear to my heart for that reason. I think it's interesting to look at the difference between, for example, the IWM, the Russell, and S&P and Dow, and get a feeling for what's going on in the market. So all these peaked, before the February debacle. And what happened is the other ones have come up past that, i.e., I think the Russell is quite a bit past it. So ever since the kind of February debacle, the small caps have done better. So, I mean, I think that's how I think about, these interesting idiosyncrasies of the market. What's happened since, kind of big deals. And so, I think that's somewhat telling. The bigger industrial stocks haven't really recovered since February, whereas the smaller caps have. That's at least the way I look at it, Mark.
Yeah, small caps have been a fascinating story to watch. Of course, check out our TWIFO program every Thursday, 1:30 p.m. Central, if you want to hear more from the folks at Russell about exactly what's been going on, why Russell has been outperforming a lot of the other indices, particularly in this very macro-heavy, trade war-heavy environment out there. Let's keep on rolling, though, keeping with the broad market sentiment theme for a little bit. The folks over there at Bank of America Merrill Lynch, they do their global fund manager survey. This most recent data coming out from the end of June, and they surveyed fund managers and asked them just quite frankly, when do you think the next recession will begin? And looking at the data, a bunch of different choices. They broke down the years into effectively half one of the year and half two, so two separate halves. It wasn't as a great degree of specificity in what they had to guess. It wasn't like this month or anything along those lines. And the majority of the fund managers that they polled expect the next recession to begin in the second half of next year or the first half of 2020. Looking at the data here, the second half of 2019, as of June, actually an increase. The amount of people who believe this increased in their survey. I guess they do a survey every month, so we'll have to get the most up-to-date data right now for August here. But going through the end of June, it was actually increased from May. It was up to about 35%. So the second half of 2019, that's up from about 30% in the month before, so a little bit of an increase there. Also, the first half of 2020 got about close to 30, looks like about 28%. The legends on this graph are not exactly legible, with looks like about 26% for May of the month before. So the pessimistic outlook is growing only a fraction of a percent, saying second half of this year, which go figure, this year we're getting into the second half pretty well already. So I think we probably would have it, at least the blips of it on the radar. And then the first half of 2019, only about 10% saying the recession will begin then. So if you're a near-term bull, I guess this data is a little bit optimistic, a little bit cheerful for you. And if you're a bear, I guess you got to wait a little bit. Let's go back to the folks over there in the Swan team, the dynamic duo of Swan. Does this gel what you guys are thinking? And when do you guys agree, disagree with this data? When's your personal radar for the next looming crisis coming up?
Well, I do want to say about the poll here. I saw similar polls a year ago, and they were all pointing that they would start the second half of 2018. So the answer is, as long as the market is setting new highs or near new highs, this poll that we take every single year is just going to get pushed back another year, another year, another year. But the important thing is it's just a poll. So we know polls are subject to a limited amount of or population risk when you're looking at data. The other thing is that the masses are usually wrong. And one of the things that we do here at Swan is, well, we don't profess to market time. So I think this falls into the market timing bucket, which can be very, very difficult. There's a lot of different factors to predict a recession. There's a lot of, we're in a new administration and new times and new market highs. And so it is a different market environment. So I think, it can be challenging to predict something like this. And I think it'll be much easier to predict when the recession started after we're already halfway through the recession. And I think what's going to happen in the marketplace is higher volatility, drawdowns in the marketplace, and I think that's very difficult to predict. So one of the things that you should be thinking about in a portfolio is, well, things that like we do with the defined risk strategies, always being hedged and always being prepared for when that next recession could happen. Because if you look at this poll, there's people saying it could happen now all the way to second half of 2020 and beyond. So that's a long time. That's 2 years, and especially in the marketplace where people have become somewhat myopic and what have you done for me lately? I think you need to stick to a long-term plan. Because who knows when the next recession will really, really begin. But again, when it does happen, we'll all be able to say, oh, yeah, it happened 6 months ago, but the market's already down 15, 18, 20%. So that's the difficult part about predicting things like this.
It is. In fact, this chart, you could hold up this chart when you're talking about the DRS and saying, look at the diversity of opinion about when this next recession will hit. So if they can't guess it, how can you guess it? So maybe a good argument to keep that hedge in your back pocket or be actively hedging out there. Mr. Matt, same question for you, sir. Do you have a dim view of this type of analysis, or does this resonate with you?
It doesn't really resonate that much, although there are some long-term studies of cycles that I think are somewhat interesting. But you have to be ready for a market downturn, which is why we always profess to have those way out of the money puts, try to finance them with a little bit of income producing, and then you're ready for something like that. That being said, Mark, I'm not immune to looking at some trivia. The trivia point that I liked the best was that since the presidency of Theodore Roosevelt, that would be 1910, 1909 area, every single Republican president has seen a recession in their first term. So does Trump buck the trend or not? So, and he's doing some maybe non-Republican types of things, but we'll see.
Does he buck the trend? That's a good question. We shall see as we keep on rolling with our slew of data and analysis here in the Buzz segment. We like to have our friends from OIC on the program. Eric couldn't make it. Again, he's traveling hither and yon, but his team, also the institutional team over there at OIC, do a great job of cranking out some interesting studies. This one showing the perhaps use case or perhaps maybe the lack thereof, at least right now, when it comes to pensions and endowments and their desire for using options. This is the question we get a lot. How much of these funds using options? Who's using these things? What are they using? So they try to answer these questions over there at OIC. They partnered with Greenwich and Associates, I believe, to conduct this survey. They talk about a lot of the things you traditionally would associate with pensions, funding shortfalls, all these things, how endowments and others are having issues making that happen. So one of the questions they asked in this survey was effectively, again, it was Greenwich Associates, the survey. They asked them, what are you looking to allocate to coming up? What are you looking to increase your allocation or maybe give a new allocation to? Which segments? And they listed a variety of different segments, and listed option strategies came in pretty poorly, at least when it came to pension plans and endowments. Actually, for asset managers, nearly half were interested in listed options. So that was, I guess, a boon. But asset managers, you assume them to be a little bit more transactionally oriented, maybe a little bit more market savvy. Pensions and endowments, kind of the prototypical staid, reserved type of clientele when it comes to this sort of thing. In that category, only 16% of pensions and endowments said they were interested in listed option strategies. Only 3% of them said they were interested in OTC option strategies. About 38% of the asset managers said they were interested in the latter. But they were interested in some very, shall we say, esoteric market categories, which is another thing OIC pointed out. Maybe if you're interested in these, maybe you want to be interested in listed options instead. 36% of pensions and endowments said they were interested in illiquid credit, compared to only 19% of asset managers. 31% said emerging markets. 19% said venture capital. So they're more interested in venture capital than they are listed options. Only 16% said venture. And then 40% of pensions and endowments said they were interested in private equity. Only 10% of asset managers said that. So almost 3x there, you're talking, or close to it, for about 2.5x there for interest in private equity versus listed options, which, if you know anything about private equity, you know it's a very broad bucket. It really defines a lot of things. So it's interesting and maybe a little bit disturbing that these types of funds and these types of clients are looking farther afield, which is good, but they're looking farther afield at some bizarre things. And of course, the OIC folks make some interesting points. I'll put a link to the study in the show notes so you guys can check it out for yourself. You have things like central clearing and everything else you can rely on, certainly in the listed options market, not so much in the OTC. And also, have ability to survive, all sorts of tumult in the marketplace. And yet people are looking to invest in these esoteric product categories instead of listed options, which I think is probably a little bit interesting. A lot of other charts and graphs in this study talking about the use case for options when they are using them, need for yield, portfolio protection, so on and so forth. I won't go through all of them. I'll allow you guys to check it out for yourself. When people do try to implement in option strategies on the institutional level, they also found that the due diligence takes less than a year for 3/4 of those surveyed. So if you're worried about a long turnaround time, may sound like a lot, a year, but in the institutional space, that's nothing. So less than a year, that's a good thing. So you can turn these around fairly quickly, but it's still surprising. I don't know. That one kind of struck me as odd. We had talked to Joe recently back at the OIC conference. We'll have to get them on, maybe this show or another one, maybe to talk about this study in a little bit more detail. But maybe Chris or Dan, maybe we'll start with you guys. You guys do a lot of outreach over there at Swan to talk to asset managers broadly in the space. That could be RIAs, asset managers, also pensions and endowments who should be allocating to things like the DRS. What does it tell you, or what does it maybe make you think of when you see that about 2.5 times more interested in private equity than in something as basic as listed options? Does that perhaps disturb you?
I don't really have all that much outreach, but it seems to me that it's sort of when there's the most risk on the table is when people are most willing to take risk. And so maybe there's a little bit of that reflected here. What would be interesting to know is how these pensions and endowments are planning to use the listed option strategies. Are they looking at this as a means to generate income, or are they looking at it as a way to protect their investments that have appreciated in value over the past few years? So this, for me, sort of raises more questions than it answers.
They do have a table here. They call it the top influencers of listed options strategies. I'll just run a few of those down for you. Maybe that'll provide a little bit more insight. They list portfolio protection for the asset manager at 31% versus 30% for the pension fund. So about a third of them want to protect their portfolio. About 22% of pension funds say risk diversity. The need for yield, only 11%. That's surprising. 19% for asset managers. Strategy diversity, kind of similar, I think, to risk diversity, but strategy diversity, only 11% there. And natural rebalance, 7% versus 6% for asset managers. So sounds like portfolio protection, Dan, is the primary concern here when it comes to options use.
Very good. Very good.
Matt, same question for you, sir. This data, interesting, maybe a little bit alarming after all this outreach the option space has been doing for a long time to really get not just advisors, but asset managers, pension funds, endowments on board with the use case for listed options. Then to see that they're just lured away by things like private equity. I don't know. What are your thoughts on that?
Yeah, that seemed odd to me. Joe did a nice job on this. Joe and I were on Jill Melandrino. We're actually going to start reaching out to some of his pension clients, so hopefully we could turn this tide. How about this, Mark? I'm going to bet that 16% is going to go up by next year. We have been working with a small amount of pensions, but we find that it's in line with the table that talks about what they're looking for. Be it, we see tail hedge, but also wanting to pay for tail hedge with some income. We see overriding. And that's basically what we're seeing out there for our clients, at least, Mark.
So you're buying calls on this listed option strategies percentage, huh? If only someone would list them, I would probably buy a few too.
Yeah.
They got to be cheap right now, right? So that's a good thing at the very least. Chris, same question for you, sir. I know this is an interesting one. I know you do a lot of the outreach over there with Swan as well, some of the 10th box events. What are your thoughts here on this, shall we say, lack of pervasiveness with option strategies and pension funds and endowments?
Well, what I wanted to point out here was the chart here. They have length of due diligence process, where 35% are taking less than 6 months in their due diligence process when they're implementing option strategies. And then 38% are, 6 months to 1 year. I think that's a key number to keep an eye on. And it's also a testament to, what the SIBO does, what the OIC does, what you do here on this show here, Mark, of educating people, pensions and endowments, and getting them more and more comfortable to use options as risk management tools. So I think that's going to be the key table going forward to see if we can get this due diligence process, the time it takes to implement, option-based strategies in pensions and endowments. So, I think if you had looked at this 5 years or 10 years ago, most of this would have been in the 1 to 2 years, if not greater than 2 years, to try to perform a due diligence on an options-based strategy. So again, the whole industry is moving in the right direction together with education, using, learning how to implement all these different option-based strategies, whether it's for hedging, income, or even just alpha trading, trying to add some incremental return and, whatever type of strategy you think is out there. And we got the man that can do it for us all, right? Matt, he can back test anything you want to figure out what you need to solve your solutions and or to provide solutions for your problems.
There you go. Speaking of implementing the option strategies, let's move on to that portion as well. J.D. Power, they survey advisors every year. They have 3,225 of them, so a pretty decent sample size. And they asked them to give their average satisfaction score on a bunch of different categories. Let's see the categories here. Client support, compensation, firm leadership, operational support, problem resolution, easy for me to say, and professional development. Unfortunately, there's no bucket breakout for strategies. Which one is better? Which BD is better at implementing option strategies? That would be a nice one. I think we have some data on that. We can get to that perhaps in another show. But right now, they don't break that out at JD. That's a little bit down the rabbit hole for the folks at JD Power. But looking here at implementation, the advisor satisfaction study, the top listing here was Edward Jones, followed by Raymond James and Associates, and then Stifel Financial, and then Ameriprise, all of them well above the industry average. UBS, Merrill Lynch, Morgan Stanley, Wells Fargo, all of them below the average. So UBS pretty close, so pretty close to the industry average. And when it comes to that was for employee advisors, so some of the big firms. Independent advisors, they like Commonwealth Financial. That was their number one BD, followed by Raymond James again, number two. So maybe that was the link of the two. Raymond James coming in second on both. Then Cambridge Investment Research, Cetera Financial, and Ameriprise all above the average, and then the rest below. So interesting stuff. Again, I'd like to see this data broken out a little bit more. And I know the folks at OIC, I think, have some of that data, so we can look at that. We've talked, this is the conversation, I remember having this with Randy way back years ago on the stage at the Options Industry Conference, when they had the temerity to put us on at like 8 a.m. after a night of parades in the French Quarter in New Orleans. But we actually had a packed house. I was stunned. Because people wanted to come talk about this issue, which is which BD should they use as an advisor if they want to use options. And we came back then, this is probably about 3 or 4 years ago, we came down back then, and maybe a little longer actually, because our solution at the time was, of course, go over to Brokers Express. Unfortunately, about a couple months after that panel, Schwab shut it down. So no more Brokers Express. But this is a question we get a lot here on the show, which is, where should I go as an advisor who wants to use these things. Where should I custody my accounts? Where should I execute? There's a lot of different debates about where that is. This survey not exactly touching on that, but still interesting, showing which BDs are hot. I know you guys at Swan ended up having to solve this problem by kind of developing kind of your own platform and doing a lot of that work yourself. Obviously, for a lot of the advisors out there, that maybe isn't a viable solution. So what do you guys tell people when they come to your 10th Box events or others and they say, hey, I want to try these things. I want to buy a put. I want to sell a call, but how do I go about it? Do you guys have recommendations for them?
Well, I mean, the first thing is define the problem, right? Is once a client understands what their problem is or what they're trying to solve for, then we can step in and adequately recommend what kind of strategies this have. I think we've always professed that, over the long run, having hedges in your portfolio over a long period, it protects. You cannot market time. And these are things that we have to, we're full market cycles. These are the things that we have to be cognizant about. I mean, we're not market timers here. And most people are, there's very few successful market timers out there. So again, it's getting to know the client, getting to know their understanding of options, what their portfolio makeup is, and seeing exactly where the defined risk strategy fits in their portfolio makeup. And, we have found that the DRS really fits in just about everybody's portfolio in some way, shape, or form, to have an element of equity exposure, hedged equity exposure with some income producing strategies usually works well, with people's portfolios in conjunction with other things that they might have in there.
We have a lot more studies, a lot more data to get to. Unfortunately, our show's only an hour. So I want to make sure you guys get some of your questions in as well. So without further ado, let's keep on rolling and open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. We're going to cheat a little bit on this one, too, because we're going to kick things off, actually turn the tables, asking you guys a question. This one's near and dear to Matt and my heart, at least right now, because Matt and I will be talking about this session on a panel coming up in Chicago just in a few days here, kind of the ever-present thing a lot of people are talking about in the derivatives world these days, which is the encroachment of crypto derivatives. In fact, we're going to have an advisor on that session, an RIA, who calls himself the crypto kind of blockchain advisor. So talking about the encroachment of crypto into that space is going to be an interesting part of our session. We'll be talking about it this Saturday, actually, August 25th here in Chicago. So if you're in Chicago, want to come by, want to see me and Matt in person and ask some questions about crypto derivatives, have at it. It's fun. Voice of Blockchain is the place you have to go. You can follow us on the social media, get those links to go, get those tickets over there. But Matt, in honor of that and your voyage here to the big city, the bright lights of the big city, we thought we'd ask our listeners this week. Matt and I are talking about crypto derivatives at the upcoming Blockchain Voice Conference. This week, we want to know which crypto product you'd like to see listed on a major venue next. Remember, we're talking about crypto derivatives and talking about listing on, a real centrally cleared listed exchange type major venue. Now, I know there's a lot of implied stuff floating around out there and other things. I'm not talking about that. I'm talking about, let's say, a CBO or a CME or an exchange someone has heard of that actually has clearing and regulatory oversight and all that fun stuff. That's what we're talking about. And we gave you 4 choices: Bitcoin options, Ripple options or futures, Ether options or futures, or Litecoin options or futures, or alts. You guys have other ones. You can hit us up with your own ideas, and many of you did. But Matt, since you're going to be talking about this with me in a couple of days, I'll give you pride of place on this one. What is your vote, and then what do you think is winning the day with our audience?
It's got to be Bitcoin. It's the oldest. It's the daddy. You start with that, and it's more of a store of value, let's just say. But I think that's what, if you're going to use crypto as an asset or asset class, you want to have some options on those to, protect yourself or to change or to match your investment objectives. So I'm gonna go solidly with Bitcoin there, Mark.
All right, Dan, I'll open up the floor to you. You're also welcome to come into Chicago if you want, but maybe a little bit short notice now to come check us out on the panel here. But I'm sure this is the question you guys get a lot, and I'm sure maybe an area you've been paying attention to out there in the space. Do you have a personal choice for which crypto derivatives product you'd like to see next? And also, B, more importantly, what do you think our audience is voting for?
So, Mark, I have both a personal choice and the results from my informal poll of the Swan Trading Desk here in Durango, and it's Bitcoin options. So we're gonna second what Matt said, and we'd just like to see it build out as a full product first before moving on to other things.
So that's is that 100% of the Swan Trading Desk there, all behind Bitcoin options there? Okay, so you have a secondary poll off of our poll. I like it.
Yeah. I was advocating for the physical, but that wasn't well received.
not seeing that, huh? Well, yeah, our audience is pretty much in tune with that. 68% saying they want to see Bitcoin options first. I can't really argue with that. I'd like to have some of those. It would be nice to have some puts in the big rundown and calls, obviously, in the run up, and be able to trade back and forth and look at this. People are always asking us about what will the skew be like and stuff. So to actually see them listed and to see it for ourselves would be a nice thing. 18% coming in number 2. A distant number 2 is Ether. Number 3, Ripple. I thought Ripple would do a little better. Ripple only got 8% and only 6% number 4 for Litecoin. And the others you guys have sent in, obviously going to be even less than that because you got a bunch of random suggestions on things. Let's see. What's we got next here? Oh, this kind of goes to what we were talking about before, Matt, with calendars. This comes from Alan T. He wants to know, interesting thought question, I guess, or maybe a semantics question. Does it count as a calendar if it's on 2 different underlyings, or is that more of a peers trade? So if that wasn't confusing for you enough before, listeners, when we're talking about, calendars on at the money on the same underlying, let's say an SPX or a SPY or whatever, choose whatever you want, Apple options. Now we're going to talk about, let's say, an Apple versus a Google and have an at the money call on one and a short at the money call on the other. That gets into a whole different can of worms. Mr. Matt, how do you quantify that? I look at that as a peers trade, but how do you guys quantify that in the ORAT SPAC testing system?
Yeah, a pairs trade, but I think that if it's a highly correlated, maybe like 2 market indexes, I like the trade. I mean, I like, we break down the skews. We know the put call skew. We know the time skews, and so often we like to do those types of trades where you're long one and short another, often doing a calendar. So I would call it a calendar pair, Mark.
Calendar pair, so kind of splitting the difference. Chris, any thoughts here? A semantics question from Alan T. on calendars.
Yeah, I think this is actually a great question because this intermarket spread is very useful when you have companies that are going through a merger or an acquisition. So, for example, if you have like a high-flying technology stock, which is going to trade on a higher volatility, and say it's going to merge with a slow-moving, communications type company that doesn't have that type of high volatility, you could get yourself into this intermarket calendar spread as long as you're delta neutral between the 2 stocks, and try to take advantage of the normalization and volatility. So that's kind of something very interesting. I think that's probably another great project for Matt there to kind of go back and look at, when do you have, for example, an AOL Time Warner or some of these where AOL was internet high flying and Time Warner was a fuddy-duddy stock and didn't have the type of volatility. You could put on these intermarket calendars, volatility spreads, and take advantage of that normalization of volatility between the two stocks.
There you go. Let's see. We got time. Let's do it. We got time for one more here. This comes, interesting question. This comes from Gall, Gall, Gall. He has Gall to ask this question, but I like it. He asks, how many options are actually traded by RIAs? It's a good question, an interesting question. It's a kind of a moving target a little. It kind of depends on who you talk to. I've heard a lot of different numbers and percentages bandied about over the years. It seems like it's an estimate range. I've seen it range on the low end as far down as 3 or 4% up to 13 or odds percent or so. A lot of that again kind of parses too, because a lot of that volume is being traced to IRA accounts, a lot of which is managed by advisors. So there's kind of a couple of layers of abstraction involved in getting an actual number. All of that a long way around to saying I don't know the precise percentage I have some ideas. It is somewhere in that range, I would say, that 3 to 13%. I know it's a very daring range of me to put out there, but I need to go out and I think look at some of the data out there and maybe talk to the OCC advisory team and a few others to see if we can get maybe a more concrete number somewhere in that range. Obviously, it's growing. It's been an increasing percentage for a number of years, but I have to see exactly what level it is. Maybe I have some homework this month, Mr. Matt. What do you think?
I like it when you have homework, Mark, because between you and Chris, I'll be at my desk all week. I would say on the lower end, even though I have just become a registered investment advisor, there are a lot of us out there. But as far as, we see the Sorelli studies, and we see that it's growing, but not a huge number yet. So I'd be in the middle of that range, Mark.
Yeah, because all those studies talk about the percentage of advisors who are interested in or using options, which is good and interesting, but it doesn't tell you how much volume that translates into, So that's maybe an additional question we'll have to add to the next round of OIC surveys. But I'm kind of with you. I think I'm somewhere in that middle of that range. I'd love to have it be, 15% of business, but I don't think we're quite there yet. You Swan Boys have any thoughts on this for Mr. Gall here, who wants to know how many options are RIAs actually trading these days?
Well, I don't have the pulse on the exact number, but I know it's increasing. And again, it comes down to education and trying to find solutions to problems when it comes down to portfolio management.
Yeah, it's a challenging question. I'll have to put it to the folks at OIC because maybe they have an exact, maybe they have a more exact number here. Let's see. Some of these questions I'll try to squeeze one more in for our audience because they're always sending so many questions. A lot of these are very lengthy questions. 20-year time horizon, small accounts, blah, blah, blah. We just did the crypto one. What's one we can answer very quickly? Here's I think one we could do pretty quickly. This comes from D. Riley. They want to know, I have a general question because I'm struggling with hedges. Do most people buy, I think there's a typo here, most people buying calls or put options, do they do that as hedges when they're doing, so let me read that again. Most people buying calls or put options as hedges, do they hedge in, at, or out of the money? Well, this one, not too hard. Matt probably has good data on this, but you don't have to look too hard. Look at the options chains out there. See how much. Let's look at the S&P, for example. You take your SPY or SPX or tick an index, whatever one you want, and look at where which puts are trading in terms of puts. Let's look at the puts for a hedge, and you're going to see that the large percentage of the volume is going to be in what's called the put wing, the below at the money strikes for a variety of reasons. First off, they're cheaper. That's a big driver for people. Buying in the money puts going to be expensive. And then secondly, of course, that's also kind of is intuitive to people's range of they bought a stock, it goes up. They want to protect it on this range to the downside. That's why they're buying puts to begin with. So it's a little bit more of an intuitive type trade for this as well. And there's a lot of other reasons go into it as well. Look at the skew on a lot of the big indices. You'll see the put wing volatility is bid. The calls are depressed because the people are selling calls to generate income, buying puts to hedge. So that's kind of the lion's share what people are out there doing in a lot of the big indices. Multiply that times the big funds out there that are all doing the same thing over and over again. That's why these skews get so exacerbated in many of these products. But pretty much, for the most part. And flip side of that, if you're looking at hedging with calls, like a product like VIX, that's going to be all calls all the time, and it's going to be out of the money again for the same reasons we kind of just broke down. Matt, you're the man with the data. Any thoughts on this? People, how do they hedge?
Yeah, today 50,000 SPY out of the money calls traded. The November 302, so about 5% out of the money. I don't think that was a hedge. I mean, if you're talking about hedging, and this particular person is struggling with hedging, I'm a fan of the far out of the money puts. Have something on your books. They don't. The drain isn't as big. Again, maybe you have a short put spread that you can manage to get some income. But have something on your books. So you mentioned before, Mark, units. Units just is a protection, a long put number that can protect you when the market really gets squirrely. That's what options are for. Try to find something that doesn't cost too much. That's where we see a lot of our our back tests going, and that's where I see a lot of the actual volume going. And as a matter of fact, today in SPY as well, about dollar puts traded 30,000. So that's where I'd say to this listener, Mark.
Unfortunately, we'll have to leave it there. That music means we're done. Try to squeeze in as many as we could. We can go in a couple hours just answering your questions. I'm sure a lot of you would probably like that. But Matt and Chris, I've already warned them out, and Dan with talking for an hour. But before we go, let's go back around the horn one last time. Let's start with the Swan Dynamic Duo. Gents, if people are interested in, let's say, the Swan newsletter, the good, the bad, and the ugly, checking out some of the white papers you guys have, or maybe registering for your 10th box events, where should they go? What should they do?
Yeah, we're still doing our 10th box seminars. So as you know, there's a series of regional due diligence meetings. So it's a great chance for advisors and investors to sit down with the PMs and discuss the challenges in today's marketplace and how the defined risk strategy can be part of their investment solution. You can find out more information at 10thbox.com. That's 10thbox.com. We also have 3 new blogs out there. You should check them out. One's called Times They Are Changing, that talks about the creation of the new communications sector. Speed Matters, which talks about the primary drivers of the defined risk strategy. And then we have another one that's called Keep Calm and Hedge. Talks about how hedging can be a valuable tool in an investor's portfolio.
There you go. Check it out. You can find that at Swan Global Investments. Click on the Swan blog tab at the top of the site there. You can see all of those blog entries and a lot more. If you click on the insights and click on Swan on Air, you can enjoy this fine program as well as many other good things. So head on over to Swan Global Investments and do just that. And of course, our friends over there at OIC, don't want to forget about them. They have a lot of great data. Touched on some of it today. They have a lot more. Optionseducation.org is the place you want to go. Click on that Advisors tab, top right corner of the page. Sign in, register for that, and then you get access to all this data and a lot more. We're always doing a lot of good stuff over there. So if you're an advisor, asset manager, you want to use options, you want to arm yourself with a little bit of data, they got some good stuff in it. Best of all, it's free. So go check it out. And last but not least, Mr. Matt, we gave a lot of samples of your back testing just in today's episode. So people wanted to hear about what you guys are doing. They got a good sample of it today. If listeners are intrigued after hearing that, maybe they want to test their own reverse calendar or something else entirely, sir, where should they go? What should they do?
Yeah, orats.com, ORATS.com. Hit me up, Matt at ORATS. We have a lot of exciting stuff coming out, Mark, as we always do. We're now, when you find a good back test, you want to implement it. We're working on implementation scanning and sending to brokers. As I mentioned, I registered as an investment advisor so I could help people looking to put money to work. I can help talk to them a little bit more about that. Back testing is a great way to learn about the strategies that match your investment objectives. So that's what we're doing over at ORATS, Mark. And looking forward to seeing you in Chicago, too.
Yeah, like I mentioned before, if you can't get enough of this program or you're interested in crypto, hopefully a little bit of both, you want to check us out in person, Matt and I. We'll be doing a little live dog and pony show with Julie from the CME, we're the Chief Commercial Officer, as well as Bill Ulivari, the aforementioned RIA, who's very active in the crypto and advisory space, comes from the market-making world and the options world, so kind of walks both lines there, as well as Tony Saliba is very active in that space as well. So it should be a good session. You can check us out this Saturday. That will be for the Voice of Blockchain event, so search for that if you want to get tickets for that. And otherwise, check out ORATS over there. And while you're at it, give them a follow over there on Twitter. Always put on some good stuff at Option Rats to learn more. And on behalf of Matt and everybody over there at ORATS, on behalf of Dan and Chris and the whole team over there who voted in our poll there for the Swan Trading crew, as well as Eric and all the rest of the crew at OIC, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, sending in such great questions. Keep them coming. We love them all. And we'll see you next time for more of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.